Thank you, everyone, for coming again today. We're really happy that you can make it, and then we start to have a community of people that come repeatedly, and so we can have a continued discussion on the political economy of liquidity. The theme today is the provision of emergency liquidity or emergency liquidity management, polemically titled Bagehot versus Kindleberger, and it seeks to investigate the evolving liquidity management practices of central banks over the last centuries. And so in order to discuss these issues, we have two really eminent experts with us that will share with us their ideas at the beginning of this seminar. And then we, as always, will get into the discussion. So 20 minutes for each, and then 40 minutes remaining for us to discuss. We have today with us, on the one hand, Perry Merling, who is very famous theorist of money and central banks, who's today at the Party School of Global Studies at Boston University, who started his work on Fisher-Black and the revolutionary idea of finance about 20 years ago, when I saw him for the first time, then wrote a book on the new Lombard Street, a book that really influenced a lot the interpretation of the shifting role of the Fed after the financial crisis, and has recently published a book on Kindleberger on money and empire. Among others, he has also written a paper on Bagehot was a shadow banker, but we'll hear his view today on shadow banking and Bagehot. I'm sure of that. And the second speaker today is Waltraud Schelkle, an eminent scholar, herself, of course, who's the joint chair for European public policy at the Department for Political and Social Sciences and at the Robert Schuman Center at the European University Institute in Firenze. And she has written an outstanding study on the ECB's balance sheet as a shock absorber called The Political Economy of Monetary Solidarity. She's an outstanding heterodox economist, if I may, and say so. And her work since then has often focused on the study of the European Central Bank in the face of financial instability and European solidarity. But today, she will share with us her thoughts on Bagehot versus Kindleberger. And we will start first with Perry, who will go for 20 minutes, and then it's going to be Waltraud's turn, after which we can then open the floor for everyone. And as always, you can put your questions into the chat if you want to already put it down now because you're afraid of forgetting it, and then we'll make sure that we give you your turn after our two presenters did their 20 minutes each. And I will remind you of the 20 minutes. Perry, the floor is yours.
Just here at the beginning, and I'll repeat it at the end, I want to emphasize that maybe my main point is that emergency liquidity provision is really just an extreme version of what happens every day. So that I definitely want to say that my view about this is that we do not need a special theory for lender of last resort, that it evolves, that it is implied by the correct theory for peacetime as well. And so I will try to make that make that clear. And that is a distinction from, I guess, most standard economics, which sort of does think of, well, we have ordinary theory for, and then suddenly there's these weird times, and we have an exceptional theory for that time. So I'm taking this is just the title from the announcement of the seminar, and I'm going to take issue with this versus part here. In fact, also in the description, it refers to Bagehot as having an idea that lender of last resort is at a punitive rate. Uses the word punitive, and I want to sort of take issue with that here at the beginning. Now, it's true that Kindleberger in 1978 repeatedly references the Bagehot rule as lending freely at a penalty rate. But Bagehot himself uses no such word. He speaks about lending at a high rate, and which he justifies as defending against an external drain and also to discourage casual use of the borrowing facility. And I think it's important to mention that the fact that there's lending at all is the important thing. That this is for times when there is no market rate. So this is the Bank of England providing liquidity when there isn't private provision of liquidity. So it just as a history of thought question, I guess, somebody must have added penalty to the standard Bagehot rule. And it must have been certainly in 1978, Kindleberger is obviously referring to the standard way that people think about this. Who added this? When? Why? It's a puzzle. I don't know the answer to it, but I think maybe it might be worth tracking down at some point. Bagehot does describe this high rate, as Waltraud mentioned to me, as a fine, so that there's this sort of penalty aspect to it in his language. I read this, however, as he is really trying to anticipate the objection of people like Henke who were opposed to any lending at all. Okay, so he wants to say this is not us doing them a favor. You understand? This is expensive. So he's trying to justify the central bank doing this thing by saying we're not being excessively easy on these guys. At any rate, the effect of this language is maybe to create an erroneous impression of Kindleberger versus Bagehot. So I'm going to organize the first part of my talk around two classic texts, Bagehot's Lombard Street and Kindleberger's Manias, Panics, and Crashes, which my two papers that I put on the Google Drive address. I argue that both of them are misunderstood by modern readers. But I also want to make the point, and I'm come to this at the end, that they're vital guides for present conditions, that these are not just of historical interest, that they help us think about modern situation. So that's where I'm going with this. Let me begin by saying Bagehot and Kindleberger, okay, that the commonalities between them, I think, are greater than the differences. Both of them are concerned with the international lender of last resort, for what they see as an emerging global economy, and they're worried that the central bank this responsibility is being thrust upon them, is not really ready for this. So Bagehot is worried that the Bank of England is not fit for purpose, and Kindleberger is worried that the Federal Reserve is maybe not fit for purpose. And the emerging global economy that they see, it's important. They're not really thinking about this, as supply chains and so forth. It's the single global money market and single global capital market, with its center in London and New York, respectively. And there are these triggering events for both of these books. It's the French indemnity, huge loan that France floated in London in 1872, which really brought to Bagehot's attention this idea that this is the world capital market right here in London, and it needs a more adequate backstop than the Bank of England is prepared. The thing that really, I think, triggered Kindleberger in writing Manias, Panics, and Crashes was Nixon's abrogation of Bretton Woods in 1971, taking the dollar off gold. So this is the context in which they're writing these books. I also want to point out that both of them also are writing at a time against academic orthodoxy of their time, or the emerging academic orthodoxy of their time. So Bagehot was writing really, I think, against Jevons, Money and the Mechanism of Exchange. I talk about that a bit in the paper. Kindleberger against the emerging orthodoxy. Diamond Dybvig, famous paper, Bernanke, 1983. These are mentioned in the paper that Waltraud put on the reading list. So I want to contrast with that. And here's just, I will just assert, okay, that I read both Bagehot and Kindleberger as sort of proto-money view thinkers. And I'll just point about a few little features of them that I notice. And that's what separates them from sort of orthodox economics and finance. This point of view, I noticed there was a lot of talk in previous sessions of this seminar about solvency. So the money view tends to see solvency as accounting fiction, whereas liquidity is a market fact, that the economy is a web of time-dated promises to pay, stretching into the future, but not to infinity. That intertemporal equilibrium is not a helpful understanding of the world. Money is a means of payment, not a medium of exchange. It's a means of settling a debt, is what I mean. Not sort of the grease, but between exchange of goods. Money and finance is the infrastructure of the market economy. It's not a sector of the economy, the financial sector, definitely not a veil. So money is never neutral. A key emphasis in the money view is on settlement. I noticed in previous sessions, Katerina mentioned the survival constraint. So that was Minsky's word for this. But settlement in general is the point at which you find out whether that promise to pay is actually paid. It comes due, and that's the key moment. That's where market coordination happens in the money view. Not so much like in Walrasian equilibrium, a vector of relative prices, but this ability to meet your promises when they come due. There's an asset pricing angle to that as well. The thinking of asset prices being formed in dealer markets. Okay, so these are not just forward-looking, like in finance, and liquidity is not assumed to be a zero price. In fact, in general, there's a liquidity premium in prices. It might be small in ordinary times, and then in crisis times, it can be very large. I added this third bullet point here about essential hybridity. This seminar is very interested in where does the state come into all of this. So I will just emphasize here at the beginning, and I'm sure we'll be pushback in the conversation afterwards. The money view very much tries to develop a theory of money and finance that does not have the state in it at the beginning, okay, and then bring the state in as a user of this infrastructure, a supporter of it. It's a hybrid structure. So it's not that the state plays no role, but it is a user of this infrastructure, just as everybody else is a user of this infrastructure for government finance, for monetary stabilization purposes, for global interface. Management of the global interface of your nation state with the rest of the world, regulation, enforcement. So we will. That's just by way of provocation here at the beginning. So Bagehot versus Kindleberger. So I see, as I say, I see them both as money viewers. I see them both as a lot of commonality, but they're talking about different worlds. So for Bagehot, he definitely is a gold standard guy. He's not imagining fiat standard at all, and he thinks that gold is a key. Is key to the international character of the sterling system. Maybe external discipline of the Bank of England. That's why you need to raise rates. It's in a time of crisis because of the outflow. Whereas Kindleberger is really speaking in a time of a fiat standard. It's true that it was bad. It was Nixon in 1971 taking the dollar off gold that embraced a fiat standard, but he thought it was a fiat standard before that. It was a dollar standard. That this gold thing wasn't so important. The important. Therefore, what the important thing that Nixon did in 1971 was to say that the U.S. central bank is no longer going to be taking responsibility for the global dollar system. We're going to be going it alone. We're just concerned about the United States. That's what worried him in 1971. Again, the difference between Bagehot and Kindleberger, the banking business has evolved quite a bit. So Bagehot's world is a world of commercial bills. His concept of liquidity will come to sort of funding liquidity, whereas modern banking, shadow banking, shiftability. This was already true when Kindleberger was writing in '78. It's even more true today. Shadow banking, which I define as money market funding of capital market lending. Both of them also are writing in a sort of background of empire. It's explicit empire in Bagehot's case, where the Indian structural surplus is supporting the sterling system. And in Kindleberger's case, the U.S. is operating as Bank of the World. and that's what supports the dollar, that the world continues to want to accumulate dollar reserves because it's as deposits in New York banks, and that supports the demand for the dollar. This is a story that I tell in my book that was mentioned, Matthias mentioned. So here's now some concrete. In the prep call for this, Matthias said it would be good to hear what do you mean by liquidity? So here's what I mean by liquidity, and this goes back actually. Charlie Calomiris mentioned this Brunemeyer and Peterson paper about funding and market liquidity. So I'm mentioning three concepts of liquidity: monetary liquidity, funding liquidity, and market liquidity. And I'm showing here in uses and sources accounts, like the flow of funds accounts, imagining that there's a deficit agent that therefore has more expenditures than receipts, and there's a surplus agent that has more receipts than expenditures. And so the deficit agent faces the problem of, how do I pay? Given that I am making more payments than I'm receiving. That's what it means to be a deficit agent. And the first instance is monetary liquidity, meaning using your balances of money. So that's the bottom line there, M for money, where you have a hoard of these monetary assets. It's a deposit account in general that you are using to pay to the surplus agent. So you're dishoarding, and the surplus agent is hoarding, and that's a sort of basic form of liquidity that does not require anyone, that the surplus agent accepts that cash as payment. That's what it means for it to be a means of payment, you settle debts with it. So that's not problematic. But the next two, funding and market liquidity, create some elasticity in all of this, because you might run out of money balances. In fact, typically you run out of money balance. So more generally, the way people meet deficits at the settlement is by pushing them into tomorrow. So you borrow, promising to pay back tomorrow, and the surplus agents may lend. And so that then you don't have to have money balances, and you can create this credit is a kind of elasticity around the discipline of settlement and money. You could also sell an asset, so liquidation and accumulation. But in both cases, this elasticity comes from finding a willing counterparty. Okay. There has to be somebody willing to take the other side of that transaction. Otherwise, you're back to having to pay money. You promised to pay money, now you have to pay money. So this elasticity is sort of not necessarily there when you need it. And that's why I point to the second second balance sheet here, where I'm showing banks. The alchemy of banking, the ability of a bank to basically create more of the means of payment just by expanding their balance sheet on both sides. And I'm showing lender of last resort as essentially a kind of funding liquidity, where you're creating additional money and lending it to the deficit agent, who can then spend it to meet his deficit. And dealer of last resort, where you're creating money to purchase a security from the deficit agent, and the deficit agent can. So that's the liquidation mechanism. So there's this elasticity of credit that in the private sector with non-bank agents, okay, and there's a backstop in the banking system, and then of course the central bank is a backstop to that backstop. So there's layers of this liquidity that goes on, and here's the hierarchy. I noticed in this seminar people are using this word, the hierarchy of money and credit. So that's all to the good. So here's the hierarchy as I would suggest it is, that securities at the bottom are promises to pay, which are generally promises to pay deposits. Okay, bank deposits are promises to pay currency, or the liability of the central bank. The central bank is a promise to pay international money, so that what counts as money and what counts as credit depends on where you are in the system, and it's a hierarchical system by construction. This seminar is very interested in questions of power, and I have generally not been thinking about power here, but it is hierarchy, and it is definitely true that the person the layer that can create money to help the layer below, that's a kind of power. The question I have that we might want to talk about is whether that whether it's the hierarchy that is the source of the power, or whether there's some previous sort of origin of power that creates this hierarchy, or maybe they are mutually supportive or something. In general, in the money view, we think that agents that have sort of structural surpluses, that there are cash flows moving in their direction, their liabilities can develop some money-like properties. So you would ask who are the structural surplus agents and why? That would be a way to address that question. This hierarchy is also geopolitical, I guess, or global. I noticed there's an international hierarchy of money with the dollar on the top, okay? And then the next layer down is various currencies of the global north. The next layer down, various currencies of the global south, and the next layer down, everyone else. This to be even more provocative, this hierarchy is also a hierarchy of hybridity. That at the top of this system, mostly we're dealing about private credit. That the global dollar is the liability of global banks largely. Okay, the offshore dollar is the liability of private banks. The Fed is the lender of last resort, and U.S. monetary policy is global monetary policy. What the Fed does is to set the overnight interest rate that everyone else follows. That's what's happening right now in the last 2 years. Powell moving from 0 to 5%. We can talk about that. The next layer down, as I say, the global north, those central banks have a quite different role than the Fed, because they're just managing their spread against the dollar rate in order to affect their own policy, in order to concern with balance of payments. So these are the major currencies: the euro, the yen, the British pound, so forth. Then there's the global south, or the miners. These are words in currency trading too, where this is more of a public. It's a more public, less private, less developed financial systems. So the central bank and the treasury plays a larger role, not just affecting the price, but maybe absolute capital controls and exchange rate controls and so forth. So that there's a hybridity. It's hybrid at every layer, but the relationship between public and private, between state and private, are different. So here's an image. Maybe I should have put this paper as a reading too. Where's my swap line? So this is a description of the way the Fed backstops the global system currently. Okay, the shaded region shows where the Fed is backstopping, and you can see that at the top of the system, we learned in the COVID crisis and also in the global financial crisis that if need be, the Fed is willing to backstop the money market and the capital market in the United States, and it will reach its arms around all of those, the mortgage-backed securities in particular in the global financial crisis. In terms of its lender of last resort to other countries, the liquidity swaps that it has with major central banks in the global north, I suggest, means that it is backstopping global money markets, okay, but not global capital markets, just money markets. And this new FEMA repo facility extends some lender of last resort, limited lender of last resort to the global south as well, or to any foreign or international monetary authority that has a treasury bill that it can bring to the repo market. I emphasize that this is what these trainer diagrams are showing. That what the Fed is doing is creating an outside spread. It's not necessarily this lender of last resort thing. Okay, is about last resort. It's an outside spread. It's not a penalty rate, but it's a rate away from the market in its normal times. So that's a fine, I guess. So this is the last slide. Just some other issues that maybe we want to come up in conversation. Quantitative easing, the zero interest rate policy, Silicon Valley Bank. I've seen the seminar, seems very interested in this. The fact that Silicon Valley Bank was holding the reserves of this crypto currency, USDC. Powell's normalization going from 0 to 5. People are interested in payment of interest on reserves. COVID as war finance. There's a lot of places we can take this. I will just stop here.
So thank you very much for having me. Heterodox economist, but the heterodoxy is the new orthodoxy, as you will quickly see, and that is, I was once a heterodox Keynesian economist that read Keynes as a monetary theorist, which is clearly different from the American tradition. As we see now, and Kindleberger was always therefore a great figure for me, that you look at as a Keynesian at money and finance, and Keynes has basically money and finance in every big book that he has written. So Bagehot versus Kindleberger, I do see much more difference than Perry does. That doesn't mean, and Kindleberger, and in the later editions with Aliber and Macaulay, doesn't distance himself from or themselves from Bagehot, but at the same time, it is too narrow, and this is what I'm going to say. At the same time, Bagehot has made a contribution to the political economy of liquidity. So has Kindleberger, and this is the first point I want to make after I quickly review the difference between their theory of the lending of last resort. And I do think we need a different theory for that particular situation. I don't think that you have on a daily basis the emergency liquidity management that Perry sees working in markets. Now, at the moment, markets are extremely always on the brink to some tantrum, but at the same time, I don't think that's a normal state of affairs. Then I make the argument why Kindleberger is more relevant for contemporary emergency liquidity management, because his principle of what to do implies that emergency liquidity management cannot be anymore confined, and perhaps not even at his time in the 1980s, confined to lending of last resort by central banks only. Now, that may not be a discrepancy between Perry and myself, but I don't think that's how Bagehot saw it. So here's Bagehot's rule in his own words, and I'm grateful to Perry that he has forced me to read it really in the original. The end is to stay the panic, to stop the panic, and the advances should, if possible, stay the panic. And for this purpose, there are two rules. First, that these loans should only be made at a very high rate of interest. They will operate as a heavy fine on unreasonable timidity. And this is not saying what the central bank governor that he attacks in this chapter says, it's what he says, a heavy fine. Secondly, that at this rate, these advances should be made on all good banking securities and as largely as the public asks for them. Because otherwise, they all panic if they're not sure, if the solvent merchants and bankers will panic. Note also that the whole purpose of this is that the banking reserve may be protected as far as possible. So he really thinks in something that is a finite stock of liquidity, and you need to protect it as a central bank. That has to do with exactly what Perry said. He was in a different world, gold standard and all that, but at the same time, that did mean he did think not of let's abolish the gold standard or abandon the gold standard in such emergency situations. He thought of this constraint as being absolutely there. Kindleberger says, on the other hand, puts it down to kind of one principle. You need to give maximum elasticity of liquidity supply. The lender of last resort, whoever that is, it is not confined to the central bank, stands ready to hold a run out of real and illiquid financial assets. Real assets are included in this. So in other words, the metal that is abandoned, or the housing estate that is no longer, where the markets crash, prices crash, hold a run out of assets into money by making more money available. And that is any kind of assets and not confined to central banks, just to repeat that. And in the new book, Aliber et al., I don't know whether it's in the old version that you see here on the left, they say on Bagehot's version of the lender of last resort rather dryly, it faces the difficulty that both solvency and soundness depend on the course of the panic. In other words, when a panic cannot be stopped, then the good security goes. The fire sale of assets will drive down the prices of anything, and the risk spreads up, and the good security is nowhere. It becomes a junk bond, and the solvency then also goes. And while I totally agree with Perry to say solvency is in a way an accounting or a legal fiction, it is a binding fiction on actors, on traders in these markets, and they have in principle to stop trading. So don't quite know how it may be a fiction, but a socially quite binding fiction if you are somebody trading in these markets. Now, to say why it's a good topic that we have today. They speak to political economy and to this political economy of liquidity in particular. Bagehot really talks about the social interaction under uncertainty. He talks in this, in the end, it's 2 chapters until he develops then his role. And it's clear that he says that on the one hand, these actors, ordinary men that have been put into office duty, have a public duty to perform, being directors of the Bank of England, not prone to abstract thinking, he says. And therefore, they don't quite understand what they do, even though they sometimes do the right thing. But when they later defend their action, they go back to old style kind of discipline has to be upheld and quantity theory. While the traders, the practical people, just want to have liquidity that keeps them in the market and that doesn't challenge them. And they are also not abstract thinkers. So that's why, but have in a way the right instinct that it's the liquidity that has to be provided. These different frames of mind make it, however, quite difficult because none understands basically why their practice is the right practice. Increases the uncertainty that in such a situation is in any case there, where what you should do depends on what everybody else would do, and you may all rationally go out of the market, but then the market collapses. He formulates a classic policy dilemma. You have seen this there. The Bank of England must guard against opportunistic behavior of traders who sell quickly and want to get cheap finance. That's why you need a high rate of interest, but you also need to give assurance to merchants of good standing, the solvent ones that he just says. They are still solvent under normal circumstances, and you should therefore see these securities as under normal circumstances a good security, and that as that you take it. Kindleberger is similar in the sense of takes this uncertainty very seriously and insists that, however, such an uncontrollable dynamic cannot be stopped by insistence on a penalty rate or a fine and good collateral, because it ignores this endogeneity of what is what is a good security and what is solvency. He sees a systemic risk, not so much a behavioral problem and containing a panic driven by a fire sale of assets, because he talks about these assets. That calls for the unconditional liquidity supply. He talks later as well, it was not in the quote, but about this contested mandate, that in a way the Federal Reserve must assume and have its international lender of last resort function for markets as a whole, as Perry called it. The Fed must be willing to backstop markets outside of its legal jurisdiction as part of providing this hegemonic stability, and that was another theory he had. I would like to add, it is a slightly US-centric view, because obviously it's a bit like with the lending of last resort by the central bank. You don't do it out of the goodness of your heart, but because you want to stay in the game. Because if the whole infrastructure breaks down and the mess you have created by letting financial innovation rip through the system, and then nobody knew how many risks they have loaded on their balance sheets, then in the end, you may also have to help a little bit with preventing the mayhem. In that sense, I have not quite as benevolent a view of this hegemony, but that we can leave to the discussion. Now, interestingly, while I'm saying here, look, Kindleberger said it all, Kindleberger himself had doubts in later years. And you see here what's the background why we should discuss this. I mean, has he exactly foreseen what happened with this upward ratcheting of the balance sheets of the ECB and the Federal Reserve? He says in 1996 in a Henry Thornton lecture, I suggest that the world may have pushed the doctrine of lender of last resort too far with deposit insurance for commercial banks and thrifts. So he thought a deposit insurance is actually something that creates too ready, a readiness to engage in risky finance, which is a relatively conservative view. I have here in bold the rescue from bankruptcy of such bodies as New York City. You could also say nation state like Greece or Ireland. Some corporations, such as Penn Central, Lockheed, and Chrysler Corporation, the Federal Reserve has massively bought up commercial papers. Banks too big to fail, even though their deposits exceed insured limits by wide margins. Many high-minded principles suffer from entropy or decay over time, and the lender of last resort principle may be one of them. So in a way, he goes back on his own theory and says that it creates too much moral hazard, so endogenous risk-taking, because, there's insurance or bailout capacity there. Now, I don't share that view. I would actually go with Kindleberger against Kindleberger and say, you need to take exactly what he saw earlier and say emergency liquidity management is more than lending of last resort by central banks. If you leave the central banks alone with that task, yes, then they are financially dominated and will have to do it, but that's not the only alternative. On the one hand, central banks are absolutely essential. They have deep pockets because they can print that stuff with a stroke of a pen, or now with a, just add a 0 or 3 to the sum that's on the screen. It can contain panics at speed and scale. Those who obviously fiscal authorities should do it because they have the democratic legitimacy. I mean, how? The numbers are so much exceeding national budgets that you can simply not do that at the same speed and scale as we have needed in the last few years. Some central banks can make losses with impunity. If the Brazilian central bank does it, then it may not go down so well with the markets. But the Bundesbank had historically often quite negative capital, and the Fed, nobody would give a toss whether they have negative capital standing there. Normally the sign of insolvency, because it doesn't matter. They will not be called out on it, or they pay their creditors, those who have a claim in it, in exactly the thing that they can print. This is quite important because it is a precondition for market making of last resort, and that may be needed when asset markets are actually the problem and not a liquidity, a flow problem because of the different coming in and out of cash flows. The fiscal authorities, now I don't know why it's not doing it. They can deal with this Bagehot dilemma because they can extend guarantees and attach strings that would rein in opportunistic behavior. For example, which actually central banks have done, not allowing to pay out dividends or anything like that. They can replenish the dwindling stock of safe assets. The Fed has in those high crisis times actually overissued treasury bonds that it didn't need for financing, but because in order to replenish the volume of safe assets in markets. And it can pre-commit, and should do that legally, to levy sizable fees for the public service of bailing out banks afterwards. Many central banks and many fiscal authorities actually have done this. Quite a few of European countries and the Fed and the United States have actually made quite a good profit on their bailout activity. And then the prudential regulators they always said they must come in to deal with the solvency problem and the central bank with the liquidity problem, like Perry, like Charles Goodhart. That is always a convenient fiction, as if you could differentiate between the two. These things, the difference between that is another of these endogeneities of a panic. They must, however, in advance reduce the vulnerability to panics. To me, the prudential regulators today really have a bit more to say for themselves and justify their existence by having this preventive function. Because when the panic runs, prudential regulators cannot really do very much. They must, for example, when another of these masters of the universe that are so dumb come along with another wonderful financial innovation, I think in particular of crypto finance, you must reverse the burden of proof. It's not for the regulator to prove that this is that they're right and that it is too dangerous. No, they must prove that this has a social value and add something to the instruments of hedging, of making liquidity in the market that isn't there now. And I would bet with you that the crypto finance cannot stand these tests. They also, and that's important about the macroprudential turn in regulation, is they can exercise capital controls, because macroprudential regulation is nothing else than segment markets and do what cannot speak its name, namely control capital. My last, and that's my summary really, I think the doctrine of the lender of last resort is a case of economic theory trailing actual practice, and that's my paper with Grossman and Rockoff. I mean, they show over and over again in history that the Bagehot doctrine, lending at a penalty rate against good collateral, has been more honored in the breach than in the observance. And that's exactly the point. Why is that so? Kindleberger's theory of the lender of last resort, that body, that institution must prevent that the illiquidity of the market, the systemic illiquidity when there's a run out of assets into money. That's the pertinent starting point for widening the perspective to emergency liquidity management. He's not obsessed with central banks, this heroic story that we have these days, that these men in gray suits do it all for us. And it applies it to a wider set of markets, not only that for bank credit as Bagehot does. And there are three lessons. Central bank liquidity alone may not stop a panic. You need more than that. Central banks need support from other institutional actors to escape that financial dominance. You need, for example, guarantees that tide banks over the market so that it is not forced to bail out single institutions. And then market making of last resort may be required if asset markets are the locus of an emergency, something that Willem Buiter and Anne Seibert have said actually before the crisis, and I think they were exactly right. And with Kindberger, it makes sense. Thank you very much.
Wonderful. Thank you very much, Bagehot. Really, I mean, both very thought-provoking and absolutely on time. This together is a rare gift. And so I already would like to thank you for this. I want to remind everybody in the room that you have the right, evidently, to post your questions. Those of you who have already written in the meantime, it wasn't always clear to me whether it was a question or a comment. So if you would like to restate your question, please feel free to either raise your hand or write it in the comment. I myself have prepared two, one for Perry and one for Waltraud. And I can see that maybe Nathan also would like to come in. Nathan Coombs. But let me start with Perry, and then. So my question to you is the following: I was starting to think about the notion of the penalty rate or the non-penalty rate, the high rate, and I realized that the problem really is in a market-based system that you really can't raise the rates too much, or you get the systemic problem that you're trying to fight. Right? So, is that what you're getting at essentially? That in the today's era, when you were to apply a penalty rate to the discount of these assets, you would engender then a negative liquidity spiral that you're trying to prevent. Is that possibly one of the concerns you're having, or am I misreading you? And that also links to the question of power, I think, because if the system is so leveraged that you can't apply the penalty rate, then the system forces the hand of the central bank. And that's what Waltraud just called, I think, financial dominance. And so my second question would be to Waltraud, and then the two of you can react, and then we open the floor, maybe. So I really enjoyed your second to last slide. And in a perfect world, that's exactly how it should be. Reducing the vulnerability, the macroprudential regulation, and so on and so on. Isn't there in the political economy of it the fact that reacting to emergencies, in particular now after Lehman, after they tried once to let one go, their reaction is so immediately and so quick that Pierre-Christian Fink is in the room, who's just written a brilliant piece on the 1974-1975 crisis, where he shows that the emergency is so quickly limited that there is afterwards no regulatory backlash. So there is no regulation. So the fire is extinguished so quickly that no action takes place. And so that the risk-taking goes ever bigger and ever bigger, so that the quick reaction of the central bank actually means that the other two elements that you're showing, in particular the third one for the financial regulator, is not happening. You know, isn't there a political economy link between these three? Isn't that normatively wishable, but positively almost impossible? That would be my question. And then the two of you can react, and I see that that Nathan has written something, and then others will also write something. But please, Perry, and then Waltraud, and then we open the floor.
Let me loop in the question that was in the chat about market microstructure, because I think that's related to your question. So I have read most of the literature in market microstructure. The thing that I emphasize is the trainer model, okay, in particular, which I think is not so much used in finance, but it is useful for our purposes. The difference between what I do and what they do is the standard finance market microstructure is sort of trying to make markets more efficient or something. That seems to be what they're after, okay? Whereas, and they're thinking about individual markets. So they're thinking about a particular asset or something like this. I want to do macroeconomics with this, okay? And I also want to do monetary theory with this. So I'm thinking about, this is about the determination of the level of the rate of interest, okay, in the market as a whole, not a and the way in which dealers provide where the outside spread comes from, where the inside spread comes from, all of that apparatus, okay, is my version, I guess, of market microstructure, and I use that model both for overnight markets, for 3-month markets, and for 10-year bond markets. The same model. So that's, in terms of how short rates affect long rates, okay, that's how, okay, that it's the dealers who are making bond markets, are borrowing in money markets in general to finance those positions. So when you are making it possible for them to hold their positions, then they don't have to liquidate them. They don't have to sell them. So that's what you're trying to avoid. Sometimes it's not enough, and then the Fed comes in and acts as a dealer itself and is buying these, the mortgage-backed securities that the Fed bought during the crisis, and the bonds, the corporate bonds that it promised to buy, in the COVID crisis. It didn't wind up having to buy any of them, but its promise to buy them was enough to stabilize the market. So we could speak about this for hours, but that's at least the direction that the money view would lead you to. Those three boxes, those three time trainer diagrams, one overnight, one 3-month, one 10-year, are connected because the dealers, each one is borrowing from the lower level, and that's the transmission, a monetary transmission mechanism from the thing that the Fed does control directly, overnight interest rate, to prices that are more endogenous in the world.
Great. Okay. Waltraud, and then we have 3 questions that can then be asked by the persons who wrote it.
I can be really short. I think, Matthias, you would let the central banks off the hook, or the predicament that we have created by having such a central bank heavy type of emergency management. You let that off the hook too easily if you say, oh, they don't get at the regulators. Yes, the regulators must have made some mistake because they allow things that should have never been allowed, like never to ask how this securitization happened, and if it's just done in order to sell it on. But at the same time, the situation that we have now, and there is an awareness, is that the emergency liquidity management has itself created the potential for the next emergency, because the liquidity and the leveraging in markets is just so high, and it has funded what many say now is a shadow banking system, but is a whole new range of things that are not even shadow anymore. They're quite obviously there. And a lot of legislative activity has happened. I mean, from macroprudential to this body of, these, I don't know, MiFID, the directive, the mother of all EU directives. Nobody has probably read it. Any living being cannot read such stuff. The same, however, with the legislation in the US. And therein lies also a problem. You regulate ever more these tiny little things that then are not implemented. I mean, Katharina would be able to say much more on this, so I stop here.
Thank you. This is great. So great comments, great replies. So we have Nathan, who's surrounded who can't speak loudly. So I will read his question, and then Gang Ma and Madame Galpan can read theirs or can state theirs. So Nathan writes, thank you for the fascinating presentations. I would like to ask what the speaker think is at stake in the differences between Bagehot and Kindleberger. I can't see a huge analytical difference, but there seem to potentially be significant normative divergences. So if you could react to that, then we have Gang Ma, Anna Gelpan, and Tobias 4. So it will be 4. And I just take so many questions because we have so limited time. So I apologize for that. Gang Ma?
So I just wonder, what are the limits of this, central bank as a last resort, right? So also related to the previous question, so you quickly put off the financial crisis. Seems like it's just what are the limits? So really, that's just it's a system. Our system, as long as we have a very capable central bank, there will be no financial crisis anymore. I just don't know, right? Just wonder. Yeah, that's my question. Thank you.
Thank you very much, Anna.
Thanks very much. I am curious about kind of the linguistic creep, I guess, and wondering to what extent does it make sense to talk about lender of last resort function for political entities in particular, be it New York City or Greece. Are we sort of financializing politics, or is it pre-financialized? Thank you.
Thank you. One last comment by Tobias, and then we'll have a round of answers, and then there's going to be another round of questions. Tobias.
Yeah. Thank you so much. I mean, I thought both presentations were really thought-provoking, and I was wondering what Perry and Waltraud make of, Bagehot in some other writings seems to be a great fan of free banking, right? So he says, why do we have one central bank when we have many pin factories? So how do we square on the one hand is recognition that we end up with a system where we need a central bank, but really the system we ought to have is one of free banking. How do those two visions fit together in your mind?
Well, maybe there's too much here. Maybe I'll carve off a little piece of it. This first question, what's at stake, divergence. I think one of my arguments is that in fact analytically they are very similar. Okay, what you're detecting, I think, as the difference between them comes from another 100 years of banking experience. I think that that Bagehot really does think that lender of last resort is enough. That's the limits. He's trying to argue we need to have a lender of last resort. By the time the Kindleberger comes around, he's had this experience in the Depression, and he does not believe that lender of last resort would have been enough to prevent the Great Depression. His book on the Great Depression, The World in Depression, 1973, which he wrote before Manias, Panics, and Crashes. He says there's three things you need from the leader. The first one, or he lists it third actually, is lender of last resort. But you also need somebody to step in to stabilize commodity markets, and you also need somebody to step in to provide long-term lending, capital markets. So capital markets and commodity markets. He said the breakdown of those two things is what caused the Great Depression. That's not necessarily the central bank. He's not necessarily thinking that that's the central bank, but somebody has to do that. And then after, in the second edition of World in Depression, he added two more because there was this experience of flexible exchange rates. So exchange rate management and also macro policy coordination. So he's now got five things, that you need a central stabilizer to do. In my talk, I was really just focusing on the very first one, that lender of last resort is about creating new money, and who can create new money? It's the central bank. It's the liability of the central bank. So that is the core, around which everything else is built. And so that's what I wanted to emphasize. I think it is useful to distinguish between that and all these other dimensions that may be necessary stabilization in a complicated modern economy. And there is mission drift, and the central bank is subject to political pressures and winds up doing things it doesn't want to do. In general, the Fed does not take credit risk. Somebody else is taking the credit risk. If you see how all their facilities are, so they are trying to limit their own intervention to lender of last resort. But I think that is true. The Fed would like not to have more responsibility than it already has, and I think that's in general true of central bankers. They're not there. That's central banking ethos in a way. When you see this is what I tell my students all the time. When you see the central banker doing a lot of things like those diagrams that Walter was showing you, it suggests failure somewhere else in the economy. Central banks should not be doing so much. So I think that's maybe where I'll leave it for that.
Yes, thank you. There'll be another round. So, Waltraud?
Nathan, I see it almost. It's interesting how you formulate it. And being pushed, I would almost say I see it the other way around. I see a deep analytical difference, and it may have to do with the historical situation. And I'm not blaming Bagehot for anything, but he thinks the money supply should be, or the liquidity supply needs to be finitely elastic. Otherwise, these chances will get at you. And a macroeconomist like Kindleberger said at that point, forget it. I mean, it has to be elastic, and as much as the market wants. You deal with the chances afterwards, the opportunistic, those who free ride basically on the central bank. So there is an analytical difference in what they see should be, so to speak, what the lender of last resort does. Normatively, I have the impression, even in this quote of Bagehot and of Kindleberger, especially later, that they think it's something that should not have to be done, but it has to be done in capitalist economies that have this tendency in their financial markets to go into panics, manias, and crashes. Right? So there I see it almost, they are similar. Gangma, I have nothing to add to what Perry said. I see it exactly like he does. Anna Gelben, that's a really difficult question. And I may have, and Kindleberger may have, you make me aware of that, we may have used the wrong examples. So that the better example for lending of last resort to public entities like countries, like cities, would be that the ECB was forced to basically accept every bond in repo financing or in bond purchases that it would normally not do, and that the market didn't want to hold anymore. I mean, for example, in particular, Italian and Spanish bonds. At that point, there was a real risk that otherwise the spillover from this would create such problems for these countries and their treasuries that we would have the next then swapping over into insolvency or simply an illiquidity of countries that have constantly had a deficit because the Great Recession had really ravished their public finances. And that was a consequence of the financial crisis. So in that sense, I think one can talk about lending of last resort, but you have a point, of course, that one needs to be much more specific if one would really write about this, because we know that, unfortunately, public bodies have no right to go insolvent and write off some of their debt, and they rather have to work it off through austerity and such counterproductive policies. Tobias, I mean, that's interesting, and I knew that once that Bagehot actually was a free banker, and that is itself a bit revealing to me. Sorry, Perry, but that really shows he has this limited perspective of somebody, the man of the markets, the economist who writes for these traders and defends them. His sociology, the economic sociology that he has, is quite interesting. And he thinks there's this instinctive knowledge of traders, but it also shows the limits of this, because I frankly think free banking is just not possible. I mean, you would have mayhem and chaos. It's like this idea of we could bring the euro through benevolent currency competition. Well, thank you. I mean, we had a little taste of that in 1992, 93. These ideas that Major had and his Tories at the time, it just show that you don't understand what money is, namely the ultimate means of settlement. Thank you.
We have Katarina, and then we have Yanis Ligakis, as well as one more, Yang Kim, I think. Katarina?
I just want to come back to the question of hierarchy and power. And I think this also relates to Anna's questions about what's the difference between a city, a state, and a corporation. And I think it depends really on the relative monetary sovereignty of these public entities. So you have to be monetarily sovereign to play the game of a lender of last resort. So you must issue your own currency, and you must issue most of your debt in your own currency too, and under your own laws. Otherwise, you look more like a corporation. So, I think cities are more like corporations, even if they're not for profit. And Argentina looks more like a private corporation to me, right? So and that of course is, and then that also I think relates to the question about how are these hierarchies created. It's of course part of the political, geopolitical economy that we are finding ourselves in. It's not an accident that first England and then the United States just hoarded all the gold and was able to control the global monetary system. So you're an empire, and not just a central bank. So I think that I've been thinking while I was listening to this debate from the political economy perspective about Charles Tilly's article about organized war making and state making as organized crimes, and he basically says this is how states emerge. It's basically you have to think like mafias. And if you're the bigger guy and you can get more friends on your side and you can bribe more clients, you can then slowly but surely sort of expand your empire. At some point you make concessions and you bureaucratize and you create the rule of law and all these institutionalizations. But at the heart, of course, there's a power struggle. And that is very real. But what we see reflected in the global hierarchy of money, I think, are power struggles that are not only the past, but they continue in the present, of course. And I think I would like to bring this more in. This not just a technocratic thing, but I think there is dominance, not only by private players, there's also dominance by public players. Thank you.
So the question of power and hierarchy played back to the both of you. Now we have Yanis and then Mr. Kim. Yanis?
Yes, thank you. I have two questions. The first one is also picking up on Katarina's question on power. And my question was if the power of money printing or like liquidity injection would be decentralized, not in a terms of who issues it, but where does it go to? So it shouldn't go to institutions, it should go directly to citizens, and then citizens should develop a higher sense of responsibility and agency over the money supply. Okay, that's number one. Do you think that's feasible? That's the first question. The second question goes back to the lender of last resort and the connection with the 1929 crisis and how could it be solved. And my question is, does it sound reasonable to you that when we have an economic barrel which is punctured all over, right, and it's losing, water left and right, that we should do a liquidity injection back into it before puncturing the holes? If we don't puncture the holes first, all we are doing is we are perpetuating and putting more money into the pockets of those that emptied the economic barrel to begin with and created the crisis. So how do you think that these checks on who bleeds the economy out of money, can be implemented? Thank you.
Thank you. One last question by, I think Mr. Kim. I find him, I don't know, young Kim. How to see the difference between money as medium of exchange and money as means of payment is a question relating back to the comment made earlier by Perry. So I'll give it back now to Waltraud and to Perry. Maybe Waltraud would like to start this time, then Perry, and then we can see if there's one more question.
On the one hand, I agree with you. It is a lot about monetary sovereignty and why in lending of last resort suddenly this hierarchy emerges. Everybody runs into the dollar, even though it emerged in dollar markets, in which European banks and so on was heavily involved, but that is the usual playbook. And therefore, the United States, that's what I earlier said, when Paris says the Fed was willing to, well, it had created the mayhem partly by sitting on its hands forever and not doing anything about this over, the Greenspan put and all these things we discussed, that then it had to underwrite the whole system that was based on dollar, in the end on dollar as the reserve currency. While I agree with you that one could bring power into it, I find it, when I taught it and talked about financial power, I always ended up with saying to the students, I'm sorry that I can't show you where it's exercised. It is elusive. To me, the problem is that it is, the way you formulated it, it sounds to me too actor-centered. And that's the problem. It is somewhere in the functioning of a system. Again, why I like Kindleberger, or think Kindleberger is more pertinent, because it isn't showing, certain individuals, while in the end, individuals have made decisions and exploited situations, and then when it went bust, they socialized all the losses that they had. Yanis, the decentralized liquidity to individuals could easily be provided if we had central banks playing with this, with the digital currencies that they are thinking about. Because you could actually take the payments function out of the banking system. And perhaps some of the hope is that you could then let a few more of them fail when push comes to shove. We will see whether it works, because I think we will go over to digital currencies. And it would have that, directly or indirectly, we would all have an account with a central bank that could, in that case, give us a liquidity. Because today, why banks have such a liquidity problem in the narrow sense, not in the sense that Anna and Katarina were talking about. has to do with that they provide us a service. With deposits, you know, I put in a euro or a dollar, and I can withdraw a euro or a dollar for that. It's not changing with, it has no market valuation. It's nominally fixed. And with that, we then know we can also pay our rent and things like that, things that actually change. And that creates an illiquidity, a problem for them. In that sense, if you want banks to have a payments function, there is a certain obligation of why central banks have to do lending of last resort. That was the origin. But we have, of course, gone way over this, and that investment banks that had no role and took no deposits whatsoever, like Goldman Sachs and all of them, could then muscle themselves into the Fed, shows that problem that Kindleberger in 1996 shows. That is, this doctrine has been overstretched. And to some extent, he's right. But then the point is not to deny this, but to change it to a wider notion of emergency liquidity management, I think. I leave the second question to Perry. It's way too difficult for me.
Well, I can't remember which one was the second one, which one was the first one. There are many of these require more thinking. The specific one that was addressed to me was medium of exchange versus means of payment. This is a reference to the way sort of standard economics understands money as double coincidence of wants, you know, that what it's solving is this problem that I may not want what you're selling, but you want how can we get over the inconvenience of barter and so forth? And so there's this whole story about monetary economics that starts from that as the problem. And I'm saying that the money view starts in a very different place. Okay, it says that transactions are made with promises to pay in general, okay, and that these promises to pay then have their own life, okay, and they're tested when that time of payment comes due, and so they're tested by, can you come up with the means of payment? That's what payment means, is providing cash. So starting from there gives you a different monetary theory than starting from the notion that there's some inconvenience of barter. And so that's a longer, but it is quite foundational. So you're quite right to pick up that I'm making that distinction, and that means that you're going to have a different monetary theory. By the way, Kindleberger is very clear about this. Money is a means of payment. If you read him, he understands that. He understands that, and that he's deviating from his colleagues, okay, in that regard. I think, Katerina, that's maybe more you were making a comment more than asking a question, so I'll just take that. It is a question, you know, the technocratic aspect of this, okay, which, you know, some minds find fascinating and you can get lost in it. I think it's also extremely important, okay, not to just use power as a shortcut to say things happen because this one has power and this one does not have power. It's like, it's actually a pretty complicated system. How actually does it work? What is the link between short-term interest rates and long-term interest rates? How the technocratic stuff is the mechanism, and it needs to be understood. And it is too much of a shortcut. And it's even as if you're trying to reform the system and make it better, just getting rid of the people with power is not. You need to know how the system works, okay, in order to reform it. And that's where I would start. And it's not easy. I think I agree that Bagehot, you know, he's a conservative country banker, is what he is, and he is talking about free banking. He's admiring what he imagines the American system is, okay, which is they don't have a central bank, right? At that time that he's writing, 1873, there is no central bank, and so he's writing in admiration of this. He didn't really understand, I think, how America worked. There was a central bank. It was J.P. Morgan, as a matter of fact, you know, in New York, and it was a hierarchical system with clearing systems in different. He didn't understand how. I think again, he is the conservative banker, and he's trying to say, well, maybe we wouldn't like to have a central bank, but we have one, you know, and so we have to. He is again giving he's giving his opponents an idea that he's on their side, that they don't like the centralized power. Okay, I get it. You don't like the centralized power, but we have it. We have to deal with it. This is exactly how he spoke about, how Parliament is organized and how the government is organized. It's like, you wouldn't do that if you were trying to rationally organize, but this is what we have. These are the institutions we have. And so we have to, he's a Darwinian in this regard, right? He's imagining that these are institutions that have evolved over time. No one planned it, no one would plan it. Okay. But here we are. These are the animals in our forest, and we have to get along with them.
Good. I want to give the last moment, maybe question, to Christine Desan, has raised her hand, and if I forgot somebody who hasn't spoken yet, then just put yourself on the list. So last round, Christine first, please.
Yeah, thanks very much. A totally fascinating set of presentations that I really enjoyed and appreciated. I guess I'll pick up, Perry, with our perennial debate, which I understood you to be provoking me to do, about whether the private comes first or the public comes first, and ask you, actually, one way to pose the question is to say, what's at stake in that debate for you? Why the emphasis on why the private comes first, which is, of course, the dominant tradition. It's the one place where you're really not heterodox, where you're more orthodox, and one way to get at that question is to ask, we agree on so much. Of course, money is a means of payment, but a means of payment and all endogenous systems of payment of credit require a unit of account. And a unit of account depends on regimes of credit and contract and obligation that are publicly constituted. Those things are not spontaneous creations, but in fact are domestic legal institutions, right? Legal creations. And in particular, again and again, we see private endogenous systems of credit using and anchored on public systems of endogenous credit creation, right? So the use of a public liability based on public obligation. So the original purveyor of endogenous credit and therefore the supplier of the unit of account, again and again, turns out to be the sovereign. Seems not coincidental, right? But enabling, especially when we think about all the work, credit, property, contract, these are legal concepts and obligations. And I think that character actually does take us to power. So I think, the technocratic is ultimately enabled and facilitated by these legal institutions, which are domestic systems, and even if they escape the control of domestic authorities, which I really liked Professor Sheckel's description of the burden of proof. So love to hear you both speak to that question.
Yes, so that's that. We could have a whole session about that. What's at stake? It maybe is something different for me than for you. You're in a law school. One of the things that's at stake for me, okay, is in fact it is not the case that standard economics puts the private first in money terms, right? There is this idea. There's actually an article coming out in the Journal of Economic Literature, just the next issue, where it's pointed out that in the standard economic models, unless there's a central bank, you don't have a theory of the price level. That the central bank creates the price level. It also creates the nominal rate of interest. That all seems to me crazy. We haven't always had central banks. What's your theory of prices? If you don't have a theory of prices without a central bank, then I think you don't have a theory of prices. That's just a deus ex machina that you're dropping onto. So you want to have a theory of where does the interest rate come from that does not say the central bank sets it. Like what would happen? There were interest rates before there were central banks. So where does the interest rate come from? What is it? What is that market doing? And then the central bank intervenes as a player in that market and pushes it around and takes responsibility for it and so forth. And that's for me the basic analytical strategy. Okay, is to try to say, well, how does it? What are the underlying ways the system works, and where does the central bank get leverage over it? Where You could tell a whole story that doesn't have a central bank at all. That's modern finance mostly, okay? But I think that just shows you there's something wrong with modern finance, that they don't have money in there in the right way. They're assuming that the price of liquidity is zero. That's a nice analytical abstraction to help you with other parts of your theory, but it's not true about the world. Similarly, as I say, this article that's going to come out, that the price level is determined by the central bank. I think it's not true. It's true in your model. I think it's not true in the world. And so that's why I'm trying to keep my attention on those matters. And perhaps that's, I think we're fighting different battles. Maybe is the difference. That's for Christine.
I would just like to say, I was also not quite sure how this is something, because sometimes public is first and private second or whatever. So I would simply say money, modern money, fiat money is public. That's why free banking is an impossibility. Those who tried it abandoned it. The United States has an experience with that in the 19th century, I think. And at the same time, you need, and this is all that is technocratic in the sense of stabilizing the system. And you may think capitalism should not be stabilized, it should just go. But given that we analyze something that is, I'm just saying you need then an actor that is public and that has the deep pockets and can make the losses that occur in a banking panic when everything is repriced and revalued. And for that, that's no private actor can do that. No, they have budget constraints, while a central bank has within the realm of the possible, usually no budget constraint, because it is a sheer accounting convention that you write on their liability side, the money stock. If you go to the central bank and hand in some money, you get back some money in a different denomination. So, and the key function is to me not your unit of account that can indeed be privatized as you have in dollarized economies, but whether you can fulfill a contract, the legal tender function, the payments function. And that means that those who have got money in return have no claim anymore against somebody else. They have it against the central bank, and as I said, that is a fiction. In that sense, there is something special about central bank money, and I think it can only be a public function, at least in the capitalism as I know it.
I would like to thank all of you for attending, and I will be so strict to suggest that we should come to an end now. It's deeply inspiring. It's also very, very deep. These debates on money, Keynes' theory of money comes into the picture immediately. And I hope we can just pick up again where we stopped here today in a month from now, on the 25th of March, when we discuss the global unit of account, namely the dollar, and the role of the Fed in setting, as Perry put it, the overnight interest rate for the globe, where everybody has to adjust to it, and what that means for the Fed. You'll get a message about this soon, and we hope you have the time to join us again. Thank you for today. It was really a wonderful discussion, and I'm really happy that we have recorded this because it's.
Thank you very much.
Thank you very much.
We enjoyed it too.
Have a great day. Bye-bye.